So the title of my presentation is Modeling with Impact, with the subtitle of What You Need to Know as an Analytics Professional. I have a fairly diverse background, as was said, so I spent a long time working in defense in the United States. I moved to Australia at first to get a PhD, and then I had an opportunity to work on the Bionic Vision Australia group. My proudest achievement is I wrote the code that was used to drive the prototype device. So people who had implants were receiving electrical stimulation into their retina based on code that I wrote. Of course, I wasn't the only person working on that, but I was part of it, and to date, this is my proudest achievement. So I've come here to tell you kind of an overview of my highlights, what I've done. This talk is primarily aimed at those of you who are just starting your careers or perhaps considering changing careers. For those of you who are experienced, not old, but experienced, this may provoke some nostalgia, and you may smile and nod and understand. So I hope you still get some enjoyment out of this talk, even if it's not directly aimed at you. So I'm going to be looking at a case study. There's a new accounting standard called IFRS 9. It may be that you say IFRS, I say IFRS. Let's call the whole thing off. In Australia, that's a similar standard known as the AASB 9, which is the Australian Accounting Standards Board. It's basically this international standard which they've implemented in the Australian jurisdiction. And this is a nice one because, well, for one, working in credit risk, this is something that's pertinent now. And also, there's a variety of tools that you need in order to solve such a problem, so I want to go through that. And the subtitle of this talk is What You Need to Know as an Analytics Professional. So as we work through this kind of case study, I'll be breaking it up with and distilling all that down into some discrete lessons. For those of you starting a career or considering changing careers, this is the points that I want to make that I think you need to know to be an analytics professional. So we have this IFRS 9 accounting standard. People normally don't consider accounting standards to be a lot of fun. And as credit risk analysts, or data analysts in general, it's kind of odd because accountants are very good with numbers, but they don't see the world in the same way that most analysts do. So you have a little bit of this culture shock between accountants, who are really good with numbers, and analysts, who are also really good with numbers, but they view the world very differently. So for those of you who are analysts, I want to give you a little bit of an introduction. What is credit risk mean? What does IFRS 9 mean? And then go through the modeling procedure that you could use if you wanted to build models in support of IFRS 9. Now, this is going to be at a high level, and the majority of the talk will be what I'm considering introduction. So I'll call that out when we get to it. So here's my one-slide introduction to credit risk. Now, I've spent 4 years in credit risk, and I'm trying to put the pertinent information onto one slide. So this is a little exciting. So as a lending institution, you make loans to people, and if they pay you back, that's profitable. And sometimes they don't pay you back, and you lose money. So this is the whole idea behind credit risk. You want to make loans to people, they pay you back, you make a profit. Of course, reality is sometimes they don't pay you back, and you want to make sure that the people that pay you back more than the people that don't pay you back so that you can turn profit. So some basic terms, there's something called provisions, and what that means is you set aside some of that money knowing that some people won't pay you back, and that will cover it. And if you go and Google credit risk, you'll probably get this equation, PD times LGD times EAD. So that's the probability they default, the loss given that they default, and the exposure when they default. So there's two basic types of provisions. In the current world, collective provisions are allotted against all loans. So you might say, right, overall, 5% of people default. And if they default, the LGD term, I lose 40%. And the amount of money they have is the amount of money they owe me at that date, EAD of 100%. And you could do that. And you say, right, I've got this hypothetical 100 loans. 5% of them are going to default. I don't know which. And of that, 40% I'm going to lose something. So however much in loans I write, I'm going to set aside 5% times 40%, or 2% of it. for everyone. Good, bad, indifferent, everyone. 2% I set aside. Well, then there's something called specific provisions, which is, okay, I've set aside this much to cover losses that I know are going to happen, but I don't know what. And in theory, for my 100 loans, because I've done my modeling exactly correctly, 5 of them default. And I say, right, not in general, but for these 5, how much do I expect to lose on each one? And maybe on some of them I expect to lose everything, some of them I expect to lose nothing, and some in between. And again, in theory, if I've done it perfectly, well, first of all, those 5 that default aren't just 5, but they also represent 5% of the total amount of loans I have. First big assumption, which isn't true in practice, but let's talk high-level theory. And it doesn't matter if I get those right or wrong, so long as overall, 40% of the amount that default on those loans, I don't get back. So in theory, the amount I've set aside from the beginning, my collective provisions, is exactly how much when I analyze the ones that default I'm going to lose in my specific provisions, which is exactly the amount of the money that I actually lose and I write off. Again, very high-level theoretical. There's lots of problems with that. But for a single slide introduction, that's provisioning. That's how provisioning works. So there's a regulatory standard that's called an advanced bank. And what it means to be an advanced bank is, as an advanced bank, I get to have my own models for PD, LGD, and EAD. So I can build my own models for assessing my own customers. And it may be that's a really good customer only has a PD of 0.5%, and a really bad customer has a PD of 7%. But I get to assess that. Now, this is a regulatory term. So if tomorrow I go and open up Savage Bank, and I'm going to use all the best stuff. I'm going to use big data and machine learning, and I'm going to use blockchains to verify all my transactions, and I'm going to be as advanced as I possibly can. I'm still not an advanced bank until the regulator says, okay, you're an advanced bank. There's a basis point. The basis point is 10 to the minus 4th, 1% of 1%. And you may say, well, what does that mean? Well, if I say my default rate is 5%, and last year was really bad, it went up by 2%, what is it now? Is it 7? Or is it 5.1? So when you're talking about percentages of percentages, things can get a little unclear, because if it was 5 and it went up by 2, that means it's 7. But no, I meant relative percent. It went up by only 10 basis points, then it's clear. And if it actually went up by 2 absolute percent, it's gone up by 200 basis points, and then it's clear. So for some other terminology, a portfolio of loans is a book. So if I talk about my book or my mortgage book or my book of loans or bank's book, and I say the book is of high quality, I don't mean, wow, it's a really engaging read. I mean, PD is low, LGD is low. It's very low risk. And if I have a loan that goes bad, and I don't think they're going to pay me back, but then all of a sudden they do, that's called a cure. So if I talk about consumers curing, that's saying they went bad, but then they got over it and they're better again. Again, this is a single slide introduction. There's a lot more we could go into. But for one slide, that's pretty good. So what you need to know as an analytics professional. Business jargon is like a language. It's a lot easier to understand. It's also like swearing, that it can be very hard to do effectively unless you're really comfortable. So if you want to go and you're in a meeting and someone's talking about PD and you're like, oh yeah, probability of default, okay, yeah, good. But if you get PD and LGD confused, people are going to notice and look at you funny. So you may ask yourself, well, how do you learn? You guys don't understand how good it is that you can just go Google some of these terms. That if you're a consultant and you get some credit risk job, you can go Google credit risk and get all kinds of introductions and everything else. Or you can just go on LinkedIn and says, hey guys, I just got a credit risk interview. Can I buy you a coffee? And it's amazing how many people are looking to be mentors who would like go to Microsoft and give a talk to free or something, right? And post it on YouTube with no expectation of everything. That's crazy, right? So you can do this. And also just if you're brought on to do some piece of data analysis work, there's 3 main reasons. It could be that they don't have capacity. So they know what they're doing, but they don't have time. It could be they don't have the capability. And that is, they have the time to do it, but they don't know much about credit risk. And you may say, well, Craig, you say there's 3, that's 2. Well, there's the dreaded both. They don't have time, nor do they have knowledge. And so if you see something like using Agile, we'll implement machine learning with big data on Azure to improve our NPS on social media blockchain with millennials, run. And those of you who understand some of those terms are probably going, what's social media blockchain? That doesn't make any sense, right? So if you just see all these jargon terms thrown together, the rest of it makes sense if you remove blockchain. I wouldn't try it, but it at least makes sense. Meanwhile, I'm here with Savage Bank saying I'm using social media and blockchain, and all the other banks are going, oh, we need the social media blockchain. Let's go get on that. The completists out there will notice there is a 4th case, which means they have the capacity and the capability. That means they do it themselves for the most part. There are some cases where for regulations or internal governance, they want someone else to build something. But in general, if they can build it themselves, why are they hiring you? So I had a 1-slide introduction to credit risk. I'm going to have a few slide introduction to IFRS 9, which aligns to the Australian version, the AASB IFRS 9. And they have a summary of rules, which they've documented in PowerPoint. This is kind of their cover slide talking about financial instruments. Note it's dated July 2014, so this is fairly old. It's about having a forward-looking model. So this was kind of inspired by the GFC. And they point out that as the financial crisis unfolded, there was this kind of earnings management. And while banks weren't required to only recognize losses once they happened, in practice, that's what they did. And that didn't work for various reasons, which I'll go into. So the standard says that the requirements are going to broaden, that they need to include expected credit losses and not just what they've lost. And it needs to be done on the basis of reasonable and supportable information that's available without undue cost or effort. And that includes forecast information. So this is getting interesting because when you build a model, it's normally based on past data. And now they're saying, actually, you need to take into account things you haven't seen yet. And as a data scientist, this is getting hard because you say, well, give me the data and I'll build you a model. They're like, well, actually, that's not good enough under the new standard. An overview is there's 3 stages, stage 1, 2, and 3. Loosely speaking, stage 1 is your collective provisions. So all of your loans that are good and active, you should set some money aside for them. Stage 3 is you know the loan is impaired. You should set some money aside from them. But then what's this stage 2? Well, stage 2 is the new one, and it says that if the credit risk increases significantly, you need to look at how much you expect to lose, not just in 1 year, but over the lifetime of the product. So for a mortgage, if you have a 30-year mortgage, it's saying, right, not just how much money do I expect to use in 1 year, how much do you expect to lose in 30 years? So if you had some short-term loan, some personal loan for a couple years, it's a couple years. For a mortgage, it could be 15 years, 30 years. If it's an interest-only mortgage, in theory, forever. Don't know how you would really price that. So this is kind of my favorite slide where they talk about, well, how do you measure this in the standard? So it needs to be a probability-weighted outcome. It's not based on the best scenario, nor the worst scenario, but some combination. And the amount you expect to lose should be based on the time value of money. So losing $1 today is worse than losing $1 tomorrow, is worse than losing $1 next year, is worse than losing $1 in 20 years. Fine. It doesn't prescribe any methods. So we can do what we like, as long as we cover this. So if you've got your deep learning cloud-based solution, and I want to get together a bunch of experts and ask them what they reckon, in theory, they're both fine. And now for my favorite bit. Now, this is great, because this is in the standard, right? That entities are not required to use a crystal ball to predict the future. Well, that's good, because I don't know many people with them. And if they were very prevalent, my need, or the need for my skills to be a credit analyst wouldn't be that good, because they just use their crystal ball. So, historical information is considered to be an important anchor. Okay, great. So I can use my past data to collect information, to build models, etc. But then it says historical data should be adjusted on the basis of current observable data to reflect the effects of current conditions and forecasts of future conditions. Suddenly becoming a data analyst is hard because they say that, okay, you don't need to know the future perfectly, but you can't just use past data, but you don't have future data, but you need to incorporate the future in your predictions, but so I get into this weird mix of, okay, exactly what do I do here? Because I need both. So what do you need to know as a professional from this? So learn your business area is what I talked about before, but I'm going to make a checklist of what I need. And my data sources should be anything that's reasonable and supportable, that is available without undue cost or effort. Now, that's not really defined, undue cost or effort. So I need a discount rate because future losses are preferable to current losses. I need to be able to classify these 3 stages so that any given loan, should I apply stage 1, 2, or 3 methodology to it. I need to forecast economic conditions. Because I need to make a lifetime loss, I need to consider whether or not it can migrate between stages. And there's no requirements on algorithms or types or anything. So this must be a lot of fun to audit, if there's any auditors in the room. Because if I give this problem to 10 analysts, I'll get back to 10 different solutions. And you may look at what I do and say, oh, I wouldn't do it that way. I'd do it the other way. Fine. Yes?
Just curious about the discount rate.
Yep.
I feel like the inflation is hard to know in the Australian economy.
Yep.
Do you prefer using present or you use 1 year?
Yeah, okay, so the question is about the discount rate, that it can be hard to know. It may be that the RBA changes rates, the inflation rate is uncertain, etc. It's a very good point. You can model that using data. You can forecast that using data. If you have a bank, there's normally a part of the bank which looks at ongoing funding costs, and someone else should be able to provide that to you in a bank. As an analyst looking to do it, normally what happens is you assume something and then you look at the impact and then you say, and of course if your discount rate is higher, future losses matter less, so this is an upper bound. And when I get to, when I talk about NAB, if I haven't answered your question a bit, wave at me. Seriously. But it's a good question because knowing the discount rate, well, I don't know. As you're saying, it's, if you want to incorporate future data, well, I don't have future data, and I might guess, but what do you do? And again, when I get to NAB, if I forget about you, just give me a wave. So let's talk about data. It needs to be reasonable and supportable information that's available without undue cost or effort. Now, I said earlier that you don't know how lucky you are to live in a world where you can just go Google things. Do you know how much data is available on the internet for free? And this is without undue cost or effort, and there's heaps of data online for free. So the financial regulator, APRA, the Australian Prudential Regulatory Authority, has data that you can go get that aggregates data from all the banks. And they have some rules here about it. And as a disclaimer, thanks to APRA, I have no affiliation with APRA, and I'm using their data, but that should not be construed that they endorse my work. Aside from a log on some server somewhere, they don't even know I have their data, and they certainly don't know what I'm doing with it. And so I'm using their data, but that doesn't mean they okay this, right? So this is an example of one of their tables. Of course, this is an Excel spreadsheet. It's one of my theories that all advanced analytics has Excel in there somewhere. And so we've got this table 5D, which looks at the 4 pillar banks of Australia. So it's a stable number of banks. And they have all these fields. The impaired facilities to loans and advances, I'm going to call that the amount that's in stage 3. They have specific provisions to impaired facilities, and I'm going to call that LGD. that of the amount that's been declared impaired, just loosely what's in default, they expect to lose about 40% of it. So I'm going to say my LGD is 40%. And then they have this past due to loans and advances. So it's not impaired yet, but it's clearly not good and active anymore. And I'm going to say, right, everything that's past due, that's my stage 2. And of course, stage 1 is 1 minus the percent in stage 2 and stage 3. Now, I can have that Excel spreadsheet, but when I go to present to clients, of course, I'm going to want to do that graphically. And the way you present matters, and the way you present matters, and it kind of identifies you with a tribe. What do I mean? I mean, if you have a graph that looks like this, I'm going to silently judge you. Because I'm going to look at it and say, you made that graph in Excel. And I'm going to silently judge you. And if your graph looks like this, I'm going to look at you and smile to say, oh, that's ggplot. And in particular, when I talked about IFRS 9 and there was the looking at recognized losses didn't work, well, they went from 0.2% from 20 basis points of impaired loans to 100 basis points within about a year and a half. So the standard exists because everyone was provisioning down here. They knew the economy was taking a turn for the worse, and 2 years later it had gone up by a factor of 7. And meanwhile, they were setting provisions down here. So this is kind of the motivation behind the standard, is you see this big peak of impaired loans. It's also interesting to note that you might think that, okay, I have these loans and they're good, and then they become late, and then they default. But actually, the impaired loans goes up faster than past due. If anything, the impaired loans predicts is a leading indicator of what's past due, but that's backward. So the data here are a bit maybe not what you would expect. And then finally, if your graph looks like this, I'm going to be a little bit confused. But this is the Excel data that I've imported to the theme of what. And I wanted to show this chart because if I move my mouse around here, nothing happens. But when I'm in PowerPoint, if I move my mouse around here, right, nothing happens. But when I previewed this and I did this, I'd get a mouse over pop-up. I don't know what happened to my mouse over pop-up. So all you Microsoft people, why don't I get mouse over information when I have Excel in my PowerPoint? I don't know. But it is interesting when you have something with mouse over and you mouse over a point, and a little thing comes up that says, this is how much it is. And you don't need to actually follow this line to figure out this is 8 basis points or 80 basis points. It's wow, like wow, information just pops up, it comes to me. It's a good thing to do when you're talking about making an impact on people. So the Australian Bureau of Statistics has a lot of macroeconomic data, because remember, I need this for predicting the future, for forecast information and what it's going to do to my credit risk. They have 119 variables. I have 54 variables. I have 54 time points. I have more variables than time points. I don't think I can use all of these. If you want to use the imports of civilian aircraft, that's in here. I decided that maybe that's not the one I want to use. So it's got the civilian labor force and unemployment, so I can calculate an unemployment rate. I've got a GDP, and I've got wages, so I can look at wage growth. And again, thanks to the ABS, I'm not affiliated with ABS. They don't endorse what I'm doing, just to be clear. So what you need to know, data isn't perfect. So you need to ask yourself, well, where did it come from? Do I understand what my data is? Is it documented? Is there someone you can ask about it? Now, both of those, to their credit, has an inquiry tab where if I had questions about it, I could contact someone. I don't know how long it would take them to get back to me, but I could. And what's your threshold for good enough? Now, those of you who know me might not be surprised that I have this data, which is at the national level of the big 4 banks with 50 time points and 100 variables, and I say, oh yeah, I'll have a go. We can get something on that. Oh, this data is completely inappropriate for IFRS 9, let's be clear. I really want account level data and to be able to track individual accounts and how they go. But national level, sure, I can build a model for that. No worries, mate. She'll be right. But what do you want to do? If you want to say, no, this isn't the data I want, I can't use this, but is it good enough to achieve your goals? And does the client understand Which brings us back to, is it that they have a capacity problem and they know the data is not actually good enough, or do they have a capability problem when they say, here, I've given you data, go? Do they understand what's going on? So let's talk about the modeling procedure. Remember, this is at a high level. If you're an analyst and you're annoyed about how little information I'm about to present, just think about those credit risk, or the accountants that I covered all of IFRS 9 in about 5 slides. And if you're an accountant and you're annoyed that I've covered IFRS 9 in 5 slides, think about the poor credit risk guys, because I covered credit risk on 1 slide. So what I'm going to do first is I'm going to put together a high-level plan. That, okay, what am I going to need? At the end of the day, I want to get down to this lifetime loss. You can either start at lifetime loss and kind of work your way backward, or you can say, well, what do I have? I have historical stage information, and I want to use that through some optimization procedure to get a stage transition matrix, which I'm going to need anyway. I'm going to compare that with my historical economic data, make a regression function so that I can get economic conditions to transitions. Then I get down to this economic forecast, and that's the interesting one. And it's interesting because if you remember, I can use my historical data as an anchor, but I can't solely use it. I need some other information. But if I can get an economic forecast, then I can forecast the stage transition because I have this relationship of economic data to stage transitions. And if I can get the forecast stage transition, well, then I can just run my stage transition into the future. And using that, I'll get my lifetime expected loss. And this will solve my stage 2 problem very quickly. So I have historical data on what stages. Again, it's not what stages, it's how much is impaired and how much is past due, which I'm counting as my stages. So I can write all this up as an optimization problem that I'm solving for all of these probabilities of transitions. Once I have those probabilities solved in some sense, I can compare that to, I can get a prediction of what my stages will look like. And with that, I can try to solve this, to try to match my predictions to what was observed at the next time step, and then do it again. And so I can write all this down subject to the conditions that these are all probabilities, so they're all between 0 and 1. And everything that was in stage 1 has to go somewhere, so all of those add up to 1. I'm not including stage 3 because I'm saying, okay, if you get to stage 3, I'm going to say you incur a loss equal to your LGD and you're gone. Is that reasonable? Not really. But it's good enough. It's good enough for a high-level introduction. So then I'll have a vector of these probabilities that I solved at each time step. And from them, I can look at the relationship between my macro variables, which I've chosen to use just simple linear regression. And linear regression, this is my copy of that book. Anyone who says linear regression is simple, I invite them to go through this book. It can take a while. This is the previous version of this book is the first thing I did when I first started working, doing analysis of simulations. And I worked through the previous version, which is probably only that thick. Took a while, but this book is the foundation of everything I know about regression. And I recommend it easily. So yeah, simple linear regression, nothing fancy. In general, regression works by you specify a function and then you solve for the parameters that best fit the function. So if you like, it's an optimization problem. It just, there's some special cases once you say, I'm going to do things linearly. You can solve things closed form, it just becomes very nice. Sure. Now I need a way to make forecasts. So that with the forecasts, I can then plug those into my found regression problem and get my transition matrix and use that to project into the future. Okay? So you can use autoregressive integrated moving average or ARIMA models. Here's an O-text. Professor Hindman? Does anyone know Rob? He's at Monash, yeah, right? So if anyone's been to Monash, you can go see this guy. One of my colleagues at Connected Analytics knows him from high school. Called him up. Again, there's all these people out there wanting to mentor you. He works at a university. He's a teacher at heart. He helped her out, set her up. Like, reach out to people. There's an O-text for it. It's free. This type of thing interests you? Go have a read. But basically what it's saying is, okay, I've got a time series, and I'm going to use the previous values of my time series to forecast into the future. So if I have everything up to time t, I can make a prediction to t plus 1. Once I have it up to t plus 1, then I can make it to t plus 2, and so forth, as far as you like. And it's good that I can go as far as I like, because as I said earlier, I need the expected lifetime of these, which could be 1 year, if it's a personal loan or a credit card or something, or it could be 30 years, if it's a mortgage. But there's no stopping me once I get this. Now the problem is, remember, I can't use historical data alone. I need to incorporate these future conditions, my future forecast. And if you have something like the GFC where there was this huge spike, well, the previous data don't tell you that. So what am I going to do? So what I did was I built the Shiny app. And this is a quick demo of the Shiny app. I've got it installed on my computer. And hopefully if I click this, it plays. It does. So that if you want to look at unemployment, you can just move it somewhere. And once you move it somewhere, all your forecasts update. So the idea here is you give this to an expert and you say, okay, I don't know what the unemployment rate is going to be next year. You move it. Move it. And as you see this, if you move that one down, these come up. Boop. So while this isn't really data analysis, now I need to get a way for the experts to talk to me. And I'm using the fact that experts like iPads, and so I give them this with an iPad and say, this little blue dot, click it to your heart's content. Move it around. Give me your prediction of where you think the economy is going. Based on your prediction, I'll then use a vector autoregressive model to model all of these in unison. Now I have future-looking macro data based on current and expected future conditions. Using those, I can get my probabilities for my transition matrix. I start with everything in stage 2. 100% of my book that is currently in stage 2 starts there. And as I project forward, some of it goes to stage 3 in green. Some of it stays in stage 2 in red. And 40% of what goes to stage 3 goes into the cumulative loss. And now it just runs. Unfortunately, the resolution on the screen is worse than there. But what you're basically seeing is this is my prediction into the future. And it starts over and runs again. And so in the first quarter into the future, everything was in stage 2. A lot of it goes to stage 3. But then it all kind of stabilizes. And about halfway through, that pops up again before it comes back down. There's a little dip in my forecast. But it's not just stable. It is varying according to the economy. And I'm looking at what's the cumulative loss, what's my lifetime loss, and then I'm done. So what you need to know, there's a variety of tools and methods out there. And you have a choice. Do you want to be a specialist or a generalist? I'm a generalist. If you want to be a specialist, what do you want to focus on? Do you want to focus on algorithms? Do you want to focus on problems? There's this perception in the media that it's all machine learning, big data. That's the tip of the iceberg. You haven't even covered the data. Where are you putting the data? How do you transfer data? The software, where do you do computations? How do you do efficient computations? Do you do things on your computer? Are you running them on a server? Can you run them on a graphics processor? We haven't talked about the hardware of that either. When you say data analysts, everyone thinks about the algorithms and the code and everything else. Well, maybe you should be the one writing the R packages that I'm using. Maybe you should be teaching. Maybe you should take Rob's job. Don't tell Rob I said that. Now I want to talk a little bit about what do I mean by algorithms versus problems. So I've looked at, as I said, as a generalist, I've looked at a lot of different algorithms, common filters, wavelets, support vector machines, k-means clustering, ARIMA models, which I've covered there, fuzzy logic and graph theory to solve various problems. So common filters to solve tracking problems. You can solve tracking problems without common filters, and you can use common filters for things other than tracking problems. So you may say to yourself, I want to be an expert in common filters. If you don't know what a common filter is, don't worry about it. My PhD is in common filters. Or you can say, actually, I want to be an expert in tracking. And common filters will be one of the tools in my bag, but I want to learn everything there is to do and how it applies to tracking. Or feature extraction, classification, clustering, forecasting, fusion, assignment. How do you want it to go? The other thing you need to know as an analytics professional is this idea of stakeholder engagement and ownership, which for IFRS 9, I need to say, no, I can't tell you what the economy is doing now. You, the expert, who look after the credit risk, who look after the book, how much do we need to provision? Where are we going? And I want to make it as easy for you to give me that information as I possibly can, but at the end of the day, you own that. You are going to inherit these models, you are going to own it, and I need to make sure you understand what you're getting yourself into. So, we're coming up to the end of the introduction to my talk. I said it was a long introduction. So I go back and I look at that list of requirements I started early, and I have a cumulative loss by month. I still need a discount factor, which I'll get to. But once I have that, I've got it. I've got my loss every month, so I can discount it all back. I've got my forecast that I'm going to base on expert input and then a vector autoregressive model as far into the future as you'd like. Using those, I can get my transition matrices based on those future predictions. And now I'm going to review this and present it to stakeholders, but sometimes you just feel like dancing when you get this done. You ever have that feeling where you're at the end, you've got it all working, and you're going to go present it to stakeholders? And as data analysts, you might think to yourself, well, there's a lot of problems here. How did you split your data into training and test? And if anyone's done any splitting into training and test, you could take some percentage of each, maybe 75-25, or maybe out of time, or sample. And no matter what you do, it's better than what I did, which was absolutely nothing. Because that's not what they're going to ask me. And then you might say, well, you're using this vector autoregressive function, that's nice. And I ran the automated var select, which says, right, using the Akaike information criterion, which number of lags is the best? Just use it. They might say, well, how do you know that's appropriate? What other metrics did you consider? What other lags did you consider? Or did you just throw it into the automated procedure and took what came out of the automated procedure? Well, actually, I just threw it all into the automated procedure and just took what was in the automated procedure, which all the analysts are kind of looking at me, a bit of shock. Yeah, because that's not what they're going to ask me either. And you might think, well, what other regression options did you investigate? I mean, you're using linear regression, Craig, for probabilities. There's no guarantee your linear regression is even between 0 and 1. What are you going to do if it comes out negative? And to be fair here, I actually looked at a lot of different options. I looked at different link functions using generalized linear regression, generalized linear models. And I eventually came to the conclusion that, well, I've got data from the GFC. So the support for my linear model is actually pretty good because I have some pretty diverse economic conditions. And if something came outside the domain of the GFC, I actually don't want my model to be used anyway. So while I considered it, I didn't actually do anything because that's not what they're going to ask me. And you may say, well, okay, Craig, what are they going to ask you? And the answer is, what's the impact? Now, the title of my talk is Modeling with Impact. And you may think that when I talk about modeling with impact, I'm talking about using the jargon and having pretty visualizations that have been made with R, not Excel. And you may think it's all about writing fancy equations on the board and going through it. But no, when I say modeling with impact, I mean, do you have the answer to this question? So if you go back to my hypothetical runaway of these guys that want me to improve their net promoter score using machine learning on big data on Azure with social media blockchains, all of that. The question is going to be, well, what's the impact? So I might go out and say what I'm going to do is I've analyzed the tweets that have been negative against Savage Bank, and what I want to do is I want to institute some chatbots so that when someone's complaining, the chatbot kicks in and says, hey, you tweeted negative. I'm so sorry, something bad happened. I'm going to intervene now so that you can delete the tweet and my negatives go down so my net promoter score overall goes up. Or I might say, well, there's this really popular Facebook of Humans of New York. Well, I want to start the Humans of Savage Bank. And what happens is when some young person comes in, I take a photo with them and I write about their journey on credit so that millennials get more positive stories. And I encourage them to share their positive stories with Savage Bank, and so their Net Promoter Score goes up. It's like, well, okay, it goes up by how much? And I might not even care about my Net Promoter Score really, but rather, if we increase the Net Promoter Score with millennials, more young people are going to come in and apply for credit cards. And if you can't give me those predictions, I don't really care. I don't really care how many different algorithms came into it. I don't really care how fancy all the math is. If you can't give me the impact, I don't care. So I want to take my own advice, and I want to say, okay, what's the impact? Well, let's go look. What would the impact be? So Ernst & Young had a survey about IFRS 9 in August 2017, so not terribly long ago. And they have the results from that. And you see there's this big bar at the bottom for both retail at the top, so consumer lending, and wholesale at the bottom. That's business lending. And there's the one bar that's really winning in both cases. That's unanswered. They don't know how much IFRS 9 is going to influence their provisions, or they just aren't telling us. And you see the other yellow ones around. Well, one here is at 10 to 15. The other one's at more than 40. They don't agree. This is a global survey, so maybe there's some jurisdiction differences. But they don't know what the impact's going to be when they change accounting standards. And if they don't have the capability, they have no idea that I'm presenting that I'm presenting constrained optimization in linear models and vector autoregression forecasts. That doesn't mean anything to them. But they do say that retail portfolios will be the most impacted, and exposures classified as stage 2, resulting in lifetime expected credit loss. Well, that's the entire game. And they're saying it's going to hit them, but they don't know by how much. Now, it so happens that National Australia Bank in 2015 implemented IFRS 9. Well, they implemented AASB 9, which is the Australian interpretation. They were one of the first, if not the first bank in the world to implement IFRS 9. And if you go read their half-yearly report, they have this nice little paragraph that total provisions for bad and doubtful debts increased by 261 million total, mainly due to an increase in collective provisions of $783 million upon conversion to AASB 9, which is about 20%. Now, in June 2015, that was about 590 million US. And so the IFRS 9 impact was roughly the GDP of an island nation. And I said when I talk about 9 to give me a wave. Maybe this wasn't their first number. I don't know. Maybe their first number was 800. Maybe it was 750. I don't know. But if it was 800, could you imagine? You're in a room with all the high-ranking people for National Australia Bank, and you've just told them, all else being equal, your profit's just gone down by the GDP of an island nation. You think they're going to sit back and look at you and say, oh, okay, but how did you split your data between training and test again? You use the Kake information criterion for your vector autoregressive models? Are you really sure that's an appropriate choice? Do you think that's the way this conversation is going to go? It's more likely they'll say, well, what discount rate did you use? I used 5%. Say, pick a number. They'll say, oh, if you make it higher, that number goes down, right? We'll make it 6%. On what basis should I make it 6%? Well, because whatever number you gave us was too high, and so if I increase the discount rate, my impact goes down. So increase the discount rate. Because that's my one tuning parameter I can use, which is a lot easier than all that other stuff I went over. My personal favorite kind of response to when you give something like this is the question of, well, how'd you get that? Sort of, were you paying attention for the past 20 slides when I went through in detail? High-level detail, sure, but I went through in detail how I got this, and now you just ask me, how'd you get that? That's kind of rich.
So can I ask a question?
Yeah, of course.
So do you know what that was as a proportion or percentage of the total lending book?
It was about 20% of their total provisions because, well, it tells you what it is. But in terms of their total book, no, I'd have to go look.
Like, did that make them from 5% to 8%? Or?
So I can't answer that question, but I can answer it a bit here. Because remember, I want to take my own advice. So I've gotten some background about, well, OK, what would the impact be for an IFRS 9 model? But I've got the data. I need, again, the discount rate. So I assumed 1% per quarter. And remember, when I'm talking about modeling with impact, it's not any of these things that I was covering first. It's actually if my model goes live tomorrow, what do you expect to happen? And there's going to be 3 things to that. First, is it going to be in line with their expectations? The second one is if it deviates from their expectations, does it go the right way? So some of them will tell you they want a kind of, they've got this range that they think based on no analysis, because otherwise you wouldn't have done the analysis. They've got some range, and if you end up being high or low, they have a preference one way or another. And working for credit risk, this is one of the standard problems you have, is that the business wants it to be plausible, but on the low end of plausible, so that they can make more loans. And the regulator says, actually, I want it to be on the high end of plausible, because I still want you to be in operation, I still want you to be a successful business, but actually we want you to be safe in case the economy turns tomorrow. So, pick one. Would you rather be the business or the regulator?
Business.
You're the business. OK, so you want something low. So, as we said, NAB was about 800 million. This is for the big 4. So if I just take 100 million, multiply it by 4, I get 3.2 billion. So I'm expecting something in the range of 3 to 3.5, and I get 2.7. Now, as a total of loans, as you asked, the total loan book of the big 4 banks was about 2.5 trillion. So it's about 10 basis points. Now, let's say he had said the opposite, and he said, actually, I'm with the regulator. Well, then I would say, well, NAB's was about 800, but NAB implemented that a few years ago. So that information is already reflected in my data, but the other 3 need to implement it. NAB's was 800. The other 3 need to implement it. This is going to go up by 2.4. Oh, look, I'm on the high side. It's 2.7. I use the same information. No one can argue that NAB's annual report or half-yearly report says what it says. This hasn't changed. But I've changed the expectation about what my answer should be. It just so happens that I'm in the middle. And I can make this number seem high or low, depending on what they want. And you laugh. And you laugh. But if this isn't in the direction they want, suddenly this discount rate starts changing, because no one knows what that discount rate is. So thanks to Microsoft and Sudarshan for setting this up. And thanks to Anant and Gurur for their help on today. Thanks to my friend Sam for setting up the video. Thank you all for coming. And of course, extra thanks to the awkward Taylor Swift dancing tumbler, because sometimes when you're looking for reasons to celebrate, watching someone dance like no one's watching can be a lot of fun. This will be going up on YouTube, and I'll be posting this presentation and the code that I used in support of everything up on GitHub. Thank you.